I've been thinking, is it possible for the US stock market to keep going up for all of eternity? Are there any examples of stock markets that don't continue to go up forever and ever? I think the prime example is the Nikkei index over in Japan. Just recently, the Nikkei hit an all-time high, but that all-time high sort of called into question. It basically calls into question whether or not any stock market, the US stock market included, can continue to go up forever and ever. As you see, the Nikkei index hit an all-time high after spending 30 years in a bear market. Could that happen to the US? Could that happen to the S&P 500? Can any stock market continually go up? You see, in our globalized economies, most stock markets, well, they're connected to each other, and a contagion in one can affect the performance of another. Likewise, when one does well, other markets tend to do well as well. Now, keep in mind, it's not a one-to-one correlation, so don't go crazy. But that's not what I'm talking about. The Nikkei index last had a similar performance to where it's at right now, in the late 1980s. And a combination of factors caused it to not perform nearly at that level for more than 3 decades. The Nikkei 225, Japan's premier stock index, it reached its zenith in late 1989, only to enter a prolonged period of stagnation and decline. And like I mentioned earlier, it just didn't hit those heights until decades later, in fact, very recently. This phenomenon is often attributed to a combination of economic policies, market psychology, global financial trends, but that does beg the question, could that happen in the US? Could there be a 30, 40, 50-year bear market for the S&P 500, for the Dow Jones Industrial Average? Well, let's take a look at some of the causes of the Nikkei index's slump and determine if there is a similar thing that could happen to the US. So, one of the big reasons for the Nikkei's slide was the asset bubble burst in the Japanese real estate market. You see, in the 1980s, Japan experienced a speculative bubble in both its stock market and its real estate prices. This was driven, like many bubbles, by excessive optimism. Also, low interest rates and a surge in asset prices. This surge in asset prices was disconnected from the fundamental value of these assets, like most asset price bubbles. But when that bubble burst, it led to a severe market correction. The cause of this bubble to even form in the first place, like with most things, can be blamed on monetary policy. You see, the Bank of Japan's monetary policy in the late 1980s, and early 90s as a matter of fact, was a similar monetary policy to what we have today. You see, what they attempted to do was to increase interest rates to curb asset price inflation. Sound familiar? And it's often cited as a precipitating factor for the market downturn. Now, that sudden increase in rates made borrowing more expensive, and that led to reducing investment and spending. That's the kind of thing that happens in most economies when interest rates rise. It's one of the things that Jerome Powell is trying to avoid here in the US. But that wasn't the only set of changes that made the Nikkei index experience a 30-year plus nadir, bear market, etc. Really, it was about structural changes in the Japanese economy. You see, Japan's economic model, which had been driven by its post-war boom, it began to show signs of strain by the late 1980s. Most of you that have been born after 1990 probably don't remember the hype and craze that was happening here in America. Basically, a fear that Japan would one day overtake the US's economy. That fear is very similar to the same fear that people today have about China taking over as the number one economy in the world versus America. You see, Japan's heavy reliance on exports and manufacturing, it faced challenges from rising competition and changing global markets, including China as a matter of fact. This structural shift contributed to the prolonged nature of Japan's economic stagnation. Another thing that's not noted as much would be the demographic trends of Japan. Following World War II, Japan's population was simply just aging, and as a matter of fact, that's been going on since then, and it continues to go on. Their aging workforce and population, well, it leads to increased spending on social services and strains public finances and reduces their global economic competitiveness. And of course, there is global and international trade. Sure, you know the late 20th and early 21st centuries have been characterized by increasing globalization and shifts in international trade dynamics. Obviously, it's been facing a little bit of headwinds lately, but that's been the trend over the last 20 years or so. And Japan's economy, which was highly dependent on exports, has seen similar fluctuations and changes in global trade patterns and currency fluctuations. So, what does that mean for the US? Could something similar happen here? The S&P 500 and Dow Jones Industrial Average have also experienced periods of rapid growth followed by sharp corrections. Think about the 1929 stock market crash and the Great Depression that followed. That's a prime example of how speculative bubbles, tight monetary policy, and structural economic shifts can lead to prolonged market downturns. Many people say that the primary reason for the prolonged Great Depression was the fact that the Federal Reserve in 1929, 1930, etc. Their tight money policies helped to create a deflationary environment. Whether or not that is true, I think the jury is still out on that to a certain degree, maybe not a large degree, as I've seen some papers and some discussions challenging that very theory. Nevertheless, we can assume, and we know as a matter of fact, that past performance is not an indicator of future performance, just because the S&P 500 has gone up for decades now, and as a matter of fact, has averaged roughly between an 8% and a 13% gain year over year. That doesn't mean that that has to continue into the future for all of eternity. U.S. stock markets are not immune to the type of economic and financial pressures that led to the Nikkei's prolonged slump. Demographic shifts, which have been occurring in America, including an aging population, also labor market constraints, they could pose long-term challenges. In addition to that, the increasing interconnectedness of global economies and the potential for asset bubbles fueled by low interest rates, not at this point in time, but speculative investments as well, could lead to scenarios where the S&P 500 or Dow Jones Industrial Average will peak, followed by extended periods of stagnation or decline. One could also assume that high interest rates that we're currently experiencing to help to overcome the high inflation rates that we're also experiencing, that could impact our economy to the point where our economy shrinks rather than grows. I say all that to say, there is no birthright for the S&P 500 to gain 8% every year for all of eternity. There may come a time where the S&P 500 is in a bear market for an extended period of time. Even then, though, I would say continue to invest in it, because as you have seen and as we have discussed, the Nikkei index eventually came out of its bear market during the Great Depression. Even though the S&P 500 wasn't around back then, the S&P 500 is an index, so if it had existed, it would have happened in the 1929 Great Depression. It eventually came back and eventually beat its original high point 15 or so years earlier. Even if the S&P 500 gets into a position where it's in a prolonged bear market, my position is to continue to invest in it, because eventually it does turn around. And you need to keep in mind that's not investment advice of any kind, just sort of the strategy that I'm going to implement. Remember, a goal without a plan is a wish. A goal with a plan and no action is a wish list. Take it easy, guys. I'm Derek West. It's Finance Squared. I'll catch you in the next video. Peace.